Hey, it's Jim, and this is level 1 of the CFA program, the topic on fixed income, and the learning module on credit risk. Let me begin by sharing a story that I tell my students all the time. Let's suppose that you want to evaluate the credit risk of a particular bond issue. I tell my students, I say, look, it's super easy. You simply compare the total amount of the bond issue, and let's suppose that it's this much. You compare that total to the operating cash flows generated by that company. Now remember, the bond issue, if it's this big, that gets paid over 5 years or 10 years or 30 years or 50 years. If you look at the operating cash flows, the annual operating cash flows, and let's suppose that they're like this. Can you see my hands out here? If they're like this, well, that sounds an awful lot to me like there's very little credit risk. On the other hand, if the amount of the bond is this much, and the operating cash flows are this much, that sounds an awful lot like there's high credit risk. And my students have come to say to me, you know what, Jim, that really doesn't give us some advice that's useful because we learned that in kindergarten. We can compare this to this. My students will say, what happens if the bond issue is this much? And what happens if the operating cash flows are this much? What happens if the bond issue is part of a larger change in capital structure, and maybe the bond issue is going like this, and maybe the operating cash flows are going like this and like this? And I look at my students and I say, maybe you have been paying attention to me over these last couple of semesters. So that's pretty much what this learning module is going to help us to decide. How to evaluate credit risk when it's not obvious. You'll see that when we look at the LOSs, right? The credit risk and its components, use of ratings from the credit agencies, and then we'll end with a conversation on yield spreads. So let's begin with this general notion of credit risk. Note that credit risk only arises when there is some kind of a loan. And that loan could be one day, right? If we're financial institutions, it could be 1 year. It could be 100 years if it were a bond issue. And if we're in a different country, like maybe England, it could be for an infinite time period. So that credit risk is essentially the potential for a default on those payments. Now, this is a legal and binding contract. So notice in that second gray box, this is a contractual relationship. Remember, the borrower makes an explicit promise. I promise to pay interest, I promise to pay principal, and I promise to pay in these amounts and on these dates. And by the way, I'm signing this document and you're signing this document. So this is legal and binding contract, which is enforceable by the justice system. Now, of course, credit risk is super determined by the specific circumstances of each borrower, plus the wider macroeconomic conditions. For example, if I came to you and said, hey, I'd like to borrow $1,000, I'll pay you back in 6 months, you would look at me and you would say, you know what, Jim, you've been a college professor for a long time, you have a good salary, you have some good retirement, you don't have a car payment, your mortgage is almost paid off, etc., etc. I probably have pretty low credit risk. But if my older son came to you and said, hey, can I borrow that same $1,000? You would look at him and say, well, he's 25 years old, just started working, still lives in his bedroom, etc., etc., right? He's got more credit risk. Although I wish I made as much money as he does as a young dude. All right, so it's important to look at those borrower-specific circumstances. Now, of course, when we lend money, whether to me or my son or to the bondholders that are out there, we're concerned about lots and lots of things. But one part of this credit risk is the underperformance of that particular asset. Let's think about a company like Johnson & Johnson. It will issue a bond and they'll use the proceeds to invest in things like, artificial hips and knees and shoulders. They'll invest in Johnson's baby shampoo. They'll invest in vaccination research and all that kind of stuff. But what happens if Johnson & Johnson issues a bond, say it's $10 billion, and they invest in these product lines and they all underperform? Right? Well, then the cash flows generated by those product lines are going to be less than what is expected. which means that as the bondholder, we have less of a chance to get that timely coupon payment and that timely maturity payment, right? So that's why we have that last one there, underperformance and losses. Here are the 5 C's of credit analysis. This is bottom up. Let me go to the next one here and show you. There's top down. The Institute is really big on this. I remember back when I was going through the program, in many of these readings, we called them readings back then, this is 20 some years ago. And these, by the way, these readings were super long. You guys I think you're incredibly lucky that the Institute made the decision to go ahead and chop the longer old time readings into much shorter and more easily manageable learning modules. But back in the old days, there was always sections on top down and bottom up. And so the Institute has an historical preference for asking bottom up and top down questions. So make sure you're aware of that, even in the context of these shorter learning modules. All right, so the 5 C's. This is specific to each individual borrower. Think of me, think of other college professors, think of younger kids who just graduate, think of a married couple who's 40 and has children in grade school paying for their education. Think of corporations, large corporations like Johnson & Johnson, mid-sized corporations, small corporations, so individual borrowers. All right, so the capacity, assess the timeliness of those debt payments. That's pretty much what I was talking about earlier, comparing this and this. If the operating cash flows, if the income of the borrower is sufficient to meet those payments, then there's probably less credit risk. How about capital? Indicates available resources. If I borrow money from a bank, I have lots and lots of resources. I have a bunch of money in my retirement account. I could always say, oh, let's use that, and I'll sell that asset and I'll repay my loan if I have to do that. Oh my gosh, I hope I never have to do something as silly as that. But corporations, they have other resources, right? If Johnson & Johnson, for some reason, can't sell any more artificial hips, well, it has the sales of the Johnson & Johnson baby shampoo to make up that kind of a deficit. So think of capital as kind of like all the available resources. Collateral, this is a really good example. What could I put up? I could put up my house, I could put up our cars, I could put up my retirement fund. I have lots and lots of collateral. Johnson & Johnson has the same kind of a thing. They could put up all of their buildings, they could put all of their assets that would back up that debt. And so the chance of default then depends on the level of that collateral. You might remember, and maybe I haven't done this yet in level 1, but you'll hear me talk about this in level 2 and level 3, is that the greatest form of collateral goes back to my favorite movies from 1960s and 1970s. Although Steve Martin did an awesome job in the early 2000s with the Pink Panther. The Pink Panther diamond is priceless, right? So if you use that Pink Panther diamond as collateral, then the level of credit risk has to be super low, maybe even zero. I tell my students that it's almost like the U.S. federal government has the Pink Panther diamond as its collateral, because we believe that the U.S. Treasury Department can issue its securities default risk free. Now, I'm not sure that the Pink Panther diamond is worth. They say it's priceless. But what's our level of debt in 2023? Over $30 trillion. Who knows anything about Pink Panther? There's your homework assignment. Go watch all of those old Peter Sellers Pink Panther movies. Covenants. These are really, really interesting things. There can be positive covenants. There can be negative covenants. Here's the example that I give my students over the last couple of years. Those of you who are sports fans might know Patrick Mahomes signed a $500 million contract to be quarterback for the Kansas City Chiefs a couple of summers ago. And make no mistake, there are covenants inside of Patrick Mahomes' contract. In fact, I read about this, even recently. There's a line in there that says something like, Patrick is not allowed to jump out of airplanes. So that's a negative covenant because the Kansas City Chiefs, they don't want Patrick jumping out and getting hurt and not being able to play football. In fact, there are a whole bunch of these things, like Patrick is, I think I read one, he's not allowed to ice skate. He's not allowed to go on a skateboard, all those kinds of things. Of course, that's true. Now, with Johnson & Johnson, there might be a covenant that sounds something like, all right, the executives are not allowed to pay the shareholders a dividend until all interest payments have been made to the bondholders. There might be another one that says, hey, you know what? This company is not allowed to merge unless it gets the approval of all the bondholders and the shareholders, right? There are positive covenants and negative covenants. What these covenants do is they protect the bondholder against any kind of misuse of funds by the executive leadership team. And then there's the character at the bottom, evaluates management quality. I think I've mentioned this to you before. I'm still reading the Paul Volcker autobiography, and he discusses some of the time that he spent on some of the major boards throughout the world. And it's really fascinating listening to, here's a Fed guy who served on the board of these publicly held companies, and he was like, you know what? He was in favor of this long time ago. We got to separate the chairman of the board and the chief executive officer into two separate positions. This kind of a thought goes back, a couple decades, but I think Paul Volcker might have been among the first to support that. Now, we'll talk at length about board of director composition and chief executives and chairman. That's a different learning module, but hey, it always helps to learn something in one module that applies to another module. All right, how about top-down factors? So what did we do? We started at the firm, we started at the borrower, and we worked our way upwards. Now let's start at the top. So these are just, kind of factors that are general to all borrowers. This means these are macroeconomic factors that are related to current economic conditions, current business environment conditions, current state of the stock market, current state of the bond market, unemployment, all that kind of stuff. And then recall that we have a learning module on geopolitics. So everything that we talked about inside of that learning module holds. And what I think is interesting about this is you have politicians who change over time. Here in the United States, we elect a president every 4 years. Sometimes they're reelected, sometimes they're not. But those individuals who serve as president, they have their own kinds of ideas about how to run the country and how to view the rest of the world. And that's pretty much inside of this legal framework inside of the United States and outside of the United States. And then we have multiple learning modules on currencies. In fact, I just made one on exchange rates and all the really cool things that are going on there. So just remember those. Here, let me go back here. Remember these C's of credit. These are bottom up, and these three are top down factors. That's got to be an exam question. Just from my thought from the historical perspective of how much the Institute loves to test on top down and bottom up. All right, the next idea is how do we repay these bond issues, right? If I'm Jim and I'm just an individual borrower, well, you're going to look at, the financial institution is going to look at my salary, my consulting, they're going to look at my retirement, they're going to look at my assets, they're going to look at all my expenses. All right, so what does that mean for corporations and government entities who issue bonds? So this is what I said at the very beginning. The main source of the repayment of the bonds is that cash flow, that operating cash flow. Is it this much or is it this much? So look, business operations, investment and finance activities. All right, so let me give you a little advice for the exam. Here's a great link between different topics and different learning outcome statements. Look, this is so cool of a question for the Institute to give you a cash flow statement. And up at the top, statement of changes in cash flow. So you got the investing, you got the financing, and you have the operating. Take a look at those three components that we talked about back in our financial statement analysis conversations, and compare that to the size of the bond issue, including business operations, which is everything on the bottom left-hand side of the balance sheet. Think Procter and Gamble, I'm sorry, what did I say earlier? Johnson and Johnson and their shampoo and their vaccine and whatever else they do. Although the Johnson and Johnson in sometime in 2023 they had I think it was called an equity carve out, but it might have been something else where they put their Johnson and Johnson and all of their consumer products into another standalone company. But that's what those business operations mean. Now, secondarily, they can sell their assets. This is not a great idea, although 20 years ago or so, Procter and Gamble sold its Jiffy peanut butter, it sold its potato chips. So Procter and Gamble got out of the food business. So those are asset sales, divestitures. But then here, this is important. We can issue additional debt. We can issue additional shares of equity. But remember, there's another link to other learning outcome statements in other topics. If we issue bonds, if we issue shares of stock to pay off a bond, well, that has tremendous capital structure implications. What happens to that debt equity ratio? That's probably a really good exam question here for a secondary source of repayment for a bond issue. Now, over on the government side, boy, I'm going to just take a deep breath here and say, all right, when governments, whether it's the national government or the local governments, whenever those entities issue a bond, they're pretty much saying to the bondholders, all right, lend us our money. Lend us your money. We're going to finance our budget deficit, and then we can tax all those people over there in the future to repay that bond issue. Now, the learning module does say something like other government revenues in there, and that's probably true. What that means is other ways the government can tax you, and maybe they don't call it a tax, maybe they call it something else out there. So, and then, of course, secondarily, they can issue new debt. Local and federal governments, they issue new debt all the time. Right here in the United States, our Treasury, maybe 2/3 of our Treasury debt has, I think I read, 2 years or less in maturity. So our federal government is constantly rolling over its debt. Or we can sell public assets. I'm a big fan here in our city of our city selling some of the streets to a local construction firm or an engineering firm. I'd be happy to use my Easy Pass and pay 12 cents to get to work so that there's less construction, the lights are all timed, etc., anywhere. So sale of public assets. All right, let's summarize what we've been talking about here and maybe add a couple of things. So sources of credit risk. We talked about macroeconomic factors. So, of course, economic downturns, recessions. We don't even have to go to the extreme of saying something like a recession. What we can do, and this is so important when we have our learning module on macroeconomic analysis and industry analysis, because we can still have increases in GDP, but inside of different industries, we can have economic recessions or economic downturns. So it's really important for us as good financial analysts to be able to say, all right, the economy is growing at 3%, but the healthcare industry is declining by 2%. So we need to focus on what happens in that healthcare industry during that time period, right? That's why the Institute asks us to know about business cycles and all that really cool stuff. For corporations, changes in business strategy. Let's go back to the board of directors. We had a little bit of a conversation here a moment ago. We have a good learning module on corporate boards. So the corporation and its board members will say something like, hey, you know what? We've been doing this for a while. We don't want to do it anymore. Johnson & Johnson baby shampoo. Market dynamics, what does that mean? It means, almost anything out there, but we have a couple of examples. Competition, declining pricing power. Look, we'll have this conversation in our capital budgeting learning module that the goal of the business, we know, maximize shareholder wealth. How do firms do that? By developing product lines that have a brand name. So brand name product lines like Johnson & Johnson baby shampoo have pricing power, right? You can charge a little bit more, but when there's intense competition, then that pricing power, that brand name, that intangible asset might decline. And then, of course, in association with market dynamics and economic downturns, there might be decreases in operating margins and increased losses. That's what my students were saying. They were saying, you know what, Jim, what happens if operating cash flows go like this and go like this and then they go like that? So those are summarized inside of operating margins. And then excessive debt service needs. This is a problem, of course, when the firm has lots and lots of debt in its capital structure. Companies that have, maybe their assets are worth, let's say, $1 billion and they only have, maybe a couple million in debt. Well, that's pretty much low credit risk because the assets are, overpoweringly large compared to the debt. But when that debt, that capital structure, that debt to equity ratio increases, well, then we need to worry about excessive debt service. Now, how about sources of credit risk for governments? Same thing, economic downturns. What does that mean? That means that we're going to be making less money as consumers, as taxpayers, which means our tax liability is going to be less. Of course, some of us might lose our jobs, right? And then we won't pay any taxes. Political instability, excessive debt service, this is true throughout the United States. There are lots and lots of municipalities out there that are going to be forced into bankruptcy over the next decade. Boy, it'll be interesting to see what kind of a bailout the federal government provides local municipalities when they can't meet their obligations. Expansionary economic policies, tax cuts, challenges in tax collection. All right, so what are those things over there? We've had a good learning module on fiscal policy. We had a good learning module on monetary policy. So remember all that stuff that we talked about for those bottom three boxes. I think this is the high likelihood of this learning module of showing up on the exam. So we have some components of credit risk, so don't confuse those with sources of credit risk back here. So let me give you an example. Let's suppose that we're one of those Rockefeller guys, and Rockefeller, he was the guy who started Standard Oil. What was that, 150 years ago? And so a direct offshoot was Exxon and then Mobil, and Exxon Mobil combined, however many years ago that was. So let's suppose that John Rockefeller wakes up today and says something like, hey, I want to issue a bond for $1 billion. And let's suppose it's a 1-year bond. It's a discount bond, pays no interest. It's going to mature 1 year for $1 billion. And let's suppose that we as bondholders, we decide to pay $950 million for that bond. So we lend him $950 million. He promises to pay us $1 billion back in 1 year. So what is the probability of default? Well, what's the chance that Rockefeller is not going to be able to sell enough of his energy products to repay that $1 billion? I don't know. That might be 5%. It might be 2%. It might be 0.0001%. It's probably not 50% or something like that. So that probability of default has everything to do with all this stuff that we're talking about here. Suppose all of these things go wrong, right? And Rockefeller defaults. What is that chance? I don't know. It's super small. But then we need to get into this concept of a loss given default. Let's go back to, let me just quickly do here. Let's go back to, where was I? Collateral. Suppose that Rockefeller says something like, hey, you know what? I'm going to use my natural gas field over there as collateral for this bond issue. If I can't pay you $1 billion in 1 year, you can take ownership of that natural gas field and then you can sell it. All right, so what's that loss given default? You might think that if Rockefeller defaults, that we lose our entire $1 billion. Well, that's not true if we have some collateral like this. So what's that collateral going to be worth? a year from now. Maybe it's worth 800 million, maybe 600 million. It's probably not going to be worth 1.2 million or 1.2 billion, because then there wouldn't be a default. Does that make sense? So let's suppose that it's worth 800 million. So we sell that. We get 800 million. What did we do? We paid 950 for it, and we were promised $1 billion for it. So if we get, what did I say, 850? So there's 150 in our loss given default. So don't fall into the trap on the exam that you're going to lose that 1 billion. I mean, you might lose the 1 billion if the company has no assets. It has no cash, no assets, nothing. You might lose that entire 1 billion, but there are always assets on the balance sheet. Go back 20 some years ago to Enron. I remember Enron sold their sideways E sign for like, I don't know, maybe $1 million or something. So the bondholders at least got $1 million from the Enron sign. You know, I have no idea who bought that or where that Enron sign is. Maybe I'll do that as my personal homework assignment. So then if we take that probability of default times the loss given default, we get something called the expected loss. Now that expected loss, so what did we say earlier? Let's take that 5% or 4% or 3% of John Rockefeller, and then multiply it by that loss given default. What was that, 150 million? Well, you get whatever that number is. So there's the expected loss in the purple. Now, what we can do is we can go ahead and compute that loss given default. We can say, hey, let's start with the expected exposure. So that expected exposure in my example was the $1 billion. But we multiply that by 1 minus the recovery rate, and that recovery rate in my example was 85%. So that's just a little formula there that illustrates my example. Now we can bring in this concept of a credit spread. Notice we have squiggly lines there. That means that it's approximately equal to the same thing as expected loss. And so look at the bottom orange. This is the great exam question. If the expected loss is equal to the credit spread, then that lender is fairly compensated through all of the numbers that we went through in this example. So this is a great exam question. Just remember my Rockefeller example. Now, I always tell my students that, I'm teaching you guys all of this stuff so that you can go out and form your own analysis about the level of credit risk associated with a particular company or with a particular bond issue. But I said, lots of people out there, they don't have the energy, they don't have the resources, they don't have the skill set, they don't have. So they rely on these ratings agencies. So I'm hoping you've heard of Moody's and Standard & Poor's. Fitch is over in the UK. And so what these ratings agencies do is they go out and they say, okay, here's the size of the bond issue. Here are the operating cash flows. This has very low credit risk. Let's go ahead and give it, hold on, I'm going to skip ahead. Let's give it a AAA rating. All right, so let's go back here. Then they say something like, all right, here's another company. Here's the size of the bond issue. This company has no cash flows. So we're going to assign this a very high level of credit risk. So there we go. C or D. D means that a bond is in default. All right, so that's what we're doing here. So uses of credit ratings. What are we doing? Assessing the issuer credit risk. Moody's and Standard & Poor's and Fitch, and there are a couple other ones out there as well. They use quantitative and qualitative analysis, which is what we're doing in the entirety of the CFA program. So of course, once you pass these exams, you are eminently qualified to be hired by these ratings agencies, and then they'll say something to you, like if you go work for Moody's, they'll say, hey, Procter & Gamble is going to issue a bond. Let's put you on an airplane, go to Cincinnati and spend a couple of weeks over there, talk to the executives, talk to the board members, talk to the people on this side and that side of the supply chain, talk to the employees, and then come back and give us a rating. All right, quantitative and qualitative analysis. What this allows us to do then is compare Procter & Gamble with Johnson & Johnson, with Best Buy, with IBM, so we can make a direct comparison of each of these companies and the bond issues. Now, what these ratings agencies will do is they will look intensely at all of the positive and the negative covenants. And they will say something like, oh boy, this company is getting close to, let's suppose the covenant might say something like, hey, the debt equity ratio cannot exceed 0.5. And so, boy, we're at 0.47, we're at 0.48, we're at 0.49. If in fact that debt equity ratio gets to be above 0.5, they're going to trigger this covenant. There might be all sorts of things that go on. There might be a ratings change. There might be lawsuits. There, of course, are going to be bond pricing changes, revaluations, and all that stuff. And then the last thing that the ratings agencies do is that the other people, like the governments and regulatory agencies, they're going to look and say, oh yeah, Moody's says AAA, that means this and this and this. Now, Moody's and Standard & Poor's and Fitch, they are not perfect. And so they make mistakes. Hopefully you're aware that they were using the terminology in the learning module, overly optimistic ratings during 2008 financial crisis. I'm going to say super incredibly overly optimistic, and really let us down back in 2008, especially with mortgage-backed securities, which they told us, oh, these are low risk AAA rating, when in fact they should have been maybe C rated. Now, that first box up there, I always find this one interesting. I mean, this is a limitation. May overlook or underestimate key financial risks. But I'm going to go ahead and wag my fingers at you guys and say, look, when you go work for Moody's, you're never going to fall into that trap because you've had great training by the CFA Institute. You know, I mean, look, the Institute is teaching us breadth and depth. However, we're humans, and there are some people out there who may underestimate key financial risks. Yeah, new regulations made agencies more transparent and reduced conflicts of interest. I think that's probably less of an issue for the exam. The other part is that, at least here in the United States, let me go back here real quick. These ratings agencies, these are approved ratings agencies by the Congress. And so some of them, it must mean that some of them are unapproved. So, I mean, I could open my own Jim's rating agency and nobody might hire me as a consultant because I haven't been approved by Congress in Washington. So here are the scales. I think for the exam, you probably need to know two things. We start with AAA. We go all the way down to C or D. AAA, that's great. C or D, that's not so great. So just think of it in terms of levels of default risk. So that's the first thing, the scale. But then you need to find a discrete interval there. Anything that is BBB or above, this is considered an investment grade. So investment graded bonds, what do they have? They have, you ready for this? Great exam questions. Investment graded bonds, they have lower default risk, which means they have a lower yield to maturity, which means they have a higher price, right? Safer bonds sell for higher prices. Makes perfect sense. BB or lower, these are junk bonds. These are high yield bonds. These are speculative grade bonds. What they have higher levels of default risk, which means they have higher yields to maturity, which means they have a lower price. You're willing to pay less for a risky bond. That makes perfect sense. Now, some things to consider is that what these analysts do at these ratings agencies, they go and they look at this stuff, and those ratings may lag market pricing or changes in credit risk. So think about that assignment. You go work for Moody's, they send you to Cincinnati for Procter & Gamble. You come back and you say, oh my gosh, I'm going to go ahead and give them a AA rating. I loved all the people there. They work really hard. They have great product lines. Capital structure's fine. And then you get home, you publish this thing, and everyone says, okay, AA rated. And then the next day, something really bad happens to Procter & Gamble, whatever that is. Yeah, some risks are hard to capture. Environmental risks, this is a huge issue, right? Litigation. Ratings may involve miscalculations or unforeseen changes. All right, what about this? Credit ratings provide valuable insight, but have limitations. Look at the dollar sign. This is what I tell my students. Look, you need to do your own analysis, rely on your own skill set, and not rely solely on the ratings. Now, let's go ahead and talk about this downgrade risk. The Institute likes to call it credit migration risk. This simply means that the AA rated firm may experience changes. I'm not going to go back through all those previous slides, but suppose all those sources there, suppose they turn negative against this corporation, and so it gets downgraded to single A. Well, this has lots and lots of implications. Of course, what's going to happen? Risk goes up, yield goes up, bond price goes down, and then we have to worry about all those covenants. And so these credit migration risks are important for bond pricing. Now let's do this last one here on yield spreads and volatility. So think about this. Suppose the 5-year Treasury bond yield is 5%. And we have a corporation that has a 5-year bond and it has a 2% credit premium. So its yield is 7%. All right, so what's that yield spread? That's 2%. Well, what can happen to that 2% over time? That 2% could inch up to 2.2% or inch down to 1.8%, right? So that could increase. But what also could happen is that it could have higher volatility. It could do something like, oh my gosh, it goes up to 2.8% and it goes down to 1.6% and then up and then down and then up and then down. So we need to worry about the absolute value of the spread. We also need to worry about the volatility of the spread, right? So bonds that have higher credit risk will have higher yields, so they'll have higher yield spreads. Bonds that, let me go back here real quick. Bonds that are in this speculative category, they probably have spreads that have greater volatility. All right, so those yield differences, that credit spread risk has the potential for greater losses due to changes in credit conditions. So my advice here for the exam is to make sure you're aware of the difference between just looking at the absolute value of the yield to maturity and compare that to the yield on a comparable Treasury security. Now, we'll have lots and lots of great conversations about yield spread and yield spread risk and how to manage all that. But for this learning outcome statement, if you can focus on those two items, I think you'll be okay. Keeping in mind that we're going to get more complex as we go forward. Now, back to this, top-down kind of an analysis. What are these macroeconomic factors? Yeah, macroeconomic conditions and the business cycle and the credit cycle. Of course, they're not independent. Thriving business cycle leads to narrowing spreads. Volatile business cycle leads to widening of spreads. And so this is a big deal. That's why even way back when I was in graduate school, the Wall Street Journal reported, yields on all these bonds, but then they reported credit, the yield spreads. And in fact, I'm still a dude. I get the Wall Street Journal. I need the hard copy. I get it in my mailbox every morning when I go out to get my local newspaper. I have to read that every morning while I'm eating my oatmeal. And the Wall Street Journal, once a week, it'll say, hey, here are the 5 bonds that have the greatest change, both up and down, in their yield spread. So this is super critical, and the Institute is aware of that. Higher credit rating, lower yield. Yeah, we know all that kind of stuff. That makes perfect sense. All right, so why do we want to invest in, let's go back here real quick. Why do we want to invest in orange or red? You might think, well, one way to manage credit risk is just to avoid those bonds that have lots and lots of credit risk. Well, there are some reasons to do this. Diversification, capital appreciation, right? Those speculative graded bonds, you might be able to get a 5-year bond for $700. And so if that firm recovers, if the economy recovers, maybe the price goes up to $800. I mean, how many stocks would you love to have bought at 7 and sold at 8? Well, it's no different if you buy a bond for $700 and sell it for $800. Now, what that means then is that those higher yielding bonds, their returns look more similar to the returns on shares of stock than the investment graded bonds. So there are two questions in there. Whoops, sorry about that. There are two questions inside of that upper half box. These high yield bonds have equity-like returns, but they're probably going to have lower volatility than equity security. So I don't want you to think of, hey, let's buy a speculative graded bond. It's just like buying a share of Procter & Gamble. I mean, it's not. There are similarities to that. And so that's probably the way the Institute will word the question. All right, how about liquidity? Most liquid bonds have lowest default risk because they're traded more often because they're in demand. And that makes perfect sense. The bonds that are in demand have the higher prices because they have lower default risk. What we need to do is go back to our economics learning module and remind ourselves about the relationship between the real rate of interest and the rate of inflation and the premium that's embedded inside of that yield to maturity. Remember, we had that building blocks model where we started with the real risk-free rate of interest, and we added a credit risk, and we added inflation risk, and we added a maturity risk premium. So that's really what that second bullet point is trying to remind us there. Down at the bottom, tax consequences, that's probably important too. All right, market liquidity risk, you probably know all about this. Transaction costs, issuer size, right? Procter & Gamble, they're huge, so they probably have low transaction costs, lots and lots of liquidity. If I'm Jim's Concrete Company, nobody knows about me, right? I probably don't have that liquidity. But then the issuer specific factors, these are all the stuff, all of the accounts that we talked about back in our financial statement analysis days. All right, one last issue here, debt coverage and leverage. Remember, this concept of leverage only exists when you have a bond issue, when you have a loan, right? So leverage means debt instead of equity to finance the purchase of long-term assets. High leverage means higher credit risk, of course. Now, the debt coverage, the leverage, that thing is entirely viewed on the balance sheet. Debt coverage is viewed on the relationship between the balance sheet, and I'll say income statement because the reading does that, but I'm going to go ahead and use my own personal words, which is what I did in the very beginning, the cash flow statement, right? The ability to cover debt with the cash flows. That's this versus this. So look, strong financial position if we have high debt coverage. And that takes us through a super fun learning module for me, at least. So I want you to go to the end here. There are just a handful of problems, and you'll have to do just a few calculations there, probability of default and loss given default, but you should be fine on these. So thanks for watching. Have a great day, and good luck studying.